Hey, folks, welcome back to the Tailored Tax Show, the podcast that helps highly paid, highly taxed, high profile, high net worth, and ultra high net worth taxpayers save a bunch on taxes legally and perennially. I'm Terrence Taylor, the co founder of Tailored Tax, and I am an enrolled agent. This is Big Al Darnell Jr. So, what's up, Big Al?
What's going on, everybody? I'm Big Al, and I love my mama.
And he's also an enrolled agent.
That's
And
right.
today we want to talk to you about using life insurance to build your own bank or
All
become your
day,
own bank. So
all
this is
day.
episode 33, using life insurance strategically to become your own bank. So Big Al, this is one of our favorite topics because
Yep.
when we started understanding the power of this instrument called life insurance and the
Mm-hmm.
ways that it can be used, we've been amazed. But the most astounding thing of all is that when you have the right insurance policy, you can borrow against it, and then you could effectively use the policy to be your own bank. So before
Yep.
we get into the tactical aspect of it, why don't you share your excitement about this? Because I know this is one of your favorite things about life
Well,
insurance.
definitely. And it's primarily because I talk about building equity centers. And when I'm talking about building equity centers, what I'm saying is that there are repositories of equity that we can build up by purchasing assets that we can draw on as we would from drawing on banks or lines of credit. So instead of having a debt center where, hey, let me use my credit card, let me use this loan, let me use this line of credit with outside institutions funds. What I'm saying is creating assets and that build up equity, which we could use as equity centers to borrow from ourselves and pay ourselves back, which puts us in complete and total control. And this is probably one of the most like explicit examples of doing just that. And that's why I like using or the idea of using life insurance as your own bank.
Cool. And we're going to get into the nitty gritty of exactly how to do that. But just a quick question, Big Al. If I have a
Yeah.
term policy, can I actually build my own bank with life insurance?
Well, it depends on what rider that you have with the policy, but with a term, no, it has to have a component of cash value, a cash value component.
Yeah. So, folks, just so you know, I was tricking my partner in crime, Big Al.
Because he's the
Because I
resident
want y'all to,
insurance expert. He's the resident insurance, and he's coming at me talking about, oh,
you know, I just want y'all to know that we both know what we're talking about. Because otherwise,
exactly.
why
Yeah.
should you listen to it? Okay, Big Al. Now that you've passed the test, let's
Thank
get
you.
into the discussion. So, Big Al, I'm going to take the heavy lifting on this. So this
Okay.
is how you do it, folks. You have your life insurance policy, and life insurance policy has to be what's known as permanent life insurance policy. So it's a policy that has to have something called cash value. You've heard us talk about this before, but for those who may be watching us for the first time, so when you have permanent life insurance, it can be one of three types of insurance, life insurance. It can be either a whole life insurance policy, it can be a variable universal life insurance policy, or it can be an index universal life insurance policy. Now, I personally like the index universal life policy, but when it comes to building your own bank, whole life index insurance policy might be something that is worth talking about as well. All three of these, so whole life, in variable universal life, and index universal life, they all have cash values. So once you have an insurance policy that has a cash value and you've built up the cash value enough to be able to borrow against it. So let's, for argument's sake, say you actually want to have a line of credit that is 50,000. Well, you have to have enough cash value built up in your life insurance policy to be able to borrow 50,000, right? And all of these life insurance policies that allow you to take policy loans tend to allow you to take up to 90% of the cash value of that life insurance policy. The cash value of the in the life insurance policy as a policy loan. Now, once you have that loan, you're free to do with that money whatever you want to or need to do. And that money in your hands is tax free. It does come with an interest rate, and you do have a choice as to whether you pay back the loan or you allow the loan to be paid once the policy pays off the death benefit, which would be when you're gone to glory to meet the makers, the ancestors, God, the universe, the universal creative mind, whatever you believe in. I happen to believe in all four. So Big Al, that's a high level overview of how the policies allow us to be able to borrow money, and that money that we borrow is what we can then use and structure as if we're our own bank, because we could use that money to invest if that's what we choose to do. We can use it for purchases if that's what we choose to do. We could use it to create other equity centers through investments and the like. So let me pause here and let you weigh in. Any
Yeah, yeah,
thoughts?
100%. The stuff doesn't happen overnight. At minimum, we're talking about a 5 year from inception period before it is in a position where you can solely use it as a bank. Otherwise, but there's a couple of components to it. You got to put the money in first, all right? Because once again, you're borrowing from your own asset. Now, Terrence and I really like index universal life insurance because it has a cash value component that mirrors an index in the publicly traded index that then allows it to grow over time. So what we're trying to do is we're trying to leverage the growth of the money that we put in. And then also we're trying to put the most amount of money in at the very beginning as possible. Because one of the downsides a lot of people say is that, oh, you're paying a lot of money on the premiums for one of these policies. And let's just say there's some period in the future where you can no longer pay this $2,500 a month premium or $1,500 a month premium or whatever that number is. It'll be different for everyone. Then you have to lose it. But here's the thing: is if you hyperfund it or overfund it in the beginning, there's nuances to the semantics of hyperfunding and overfunding. But if you front load it, I should say at the very beginning with no less than 5 years, then you should be able to be in a position where you no longer have to make these payments anymore, these premium payments, where the income that you're receiving can pay for all of the remaining payments or balances that are still owed. So what we're trying to do is not just a bank, but it's a bank that after you fund it over the first 5 years, you no longer have to continue to fund. All right. But you do have to monitor the distributions that you take from it. And the beautiful thing about using insurance to form a bank is that these distributions are tax free because they're a loan. All right. You're taking a loan from yourself instead of taking a loan from another institution. So, but now I'll tell you this, and maybe I should have talked to you about it before we got on the podcast. But there's some things I'm not sure everyone's aware about these life insurance policies that once the amount of money that you put in, let's just say that we overfund it
Yep.
or front load it, then and we have all this cash value. When everything's said and done and we go on to glory and go to heaven, Lord's willing, I believe in Jesus, then you don't get that. Your children don't get that cash value. They get the death benefit. And what they get is the death benefit minus whatever loans that you received. Isn't that correct?
Actually, I'm so glad you brought that up, Big Al. And folks, this just shows you how genuine we are about this, right? So we have the idea and we jump in, and here is a real life question that I'm sure not only just Big Al has, but many people have. Big Al, interestingly enough, if you have cash value in the policy, then the equation looks something like this. The cash value minus the loan, and then plus the death benefit is what goes to the heirs or the
Right.
beneficiaries.
Right. It's
Yes,
even
sir.
better then. Yeah. Well,
Yeah.
perfect. Because I sure enough thought it was just the death benefit. So this makes
Oh,
it
sir.
even better.
Yep. Right. And folks, here's another beautiful thing. So Big Al talked about what we both knew to be how you actually create your own bank, which is you put in that money and then you allow it the time it needs to begin to compound. So 5 years is what's recommended. But recently I learned that there's an insurance carrier, get this, Big Al, that allows you to put in money into a whole life index policy. So not an IUL, a WLI, whole life index policy. And within after 30 days, you can borrow up to 90% of the cash value in that policy.
Wow.
So, Big Al, check this out. Imagine a scenario where we want to have 10,000 as our line of credit for our own bank. So we need to
Yep.
put in enough money that we can take out 10,000 as 90% of the cash value. And that the amount of money we put in would have to also cater for the fees for the insurance company, right? So
Yeah.
insurance
Yeah.
charges and all these fees. Once that's in place, so for argument's sake, let's say you put in 15,000, and then the cash value is at 13,000. Well, if you borrow 90% of 13,000, that should give you 10,000 and some change, right?
Hmm.
Now you got 10,000. You can use that money as you see fit. And let's say you actually want much more money than that. We just add zeros. So if you're trying to get 100,000, then put in 130,000 and 150,000, and that should give you, for example, enough money in the cash value to borrow against. So the specifics are things that would need to be structured, and you would need to talk to an insurance specialist to illustrate for you how this is done. But just so you know, folks, there are two ways now for you to build your own bank. If you want to build your own bank over time, then we talk about the Index Universal Life policy and the 5-year recommended period of funding it before you start taking policy loans. Alternatively, you might be, for example, a business owner and you got cash needs, but you may have cash up front. You put in the money, you borrow against it after 30 days. And the beautiful thing is, in both scenarios, the money that you put in continues to grow as if you never touched it. This is what makes life insurance such a powerful tool, folks, and such a powerful way to build your own bank. So money that you put in continues to work for you as if you never touch it, while you're still allowed to borrow based on the cash value.
It's
All right, Big
phenomenal.
Al. So
Absolutely
let's wrap
phenomenal.
this up. Any
Yes, sir.
closing thoughts?
No, I appreciate the insight that you gave on that last question. I think that would be great for all the viewers to understand as well. And no, I
And the
think this,
listeners. Mhm.
yeah, it's right. The viewers and the listeners.
Yes.
So no, no, I think this is a great episode, man.
All right, thank you so much. Hey, folks, thank you for spending time with us. And if you want some assistance in understanding how to build your own bank, why don't you go to the OpenAI GPT store? So, OpenAI is the parent company of ChatGPT. The GPT store allows you to use tailored insurance guide. You could ask the question of how do I build my own bank with life insurance? It would answer that for you straight out. And also, if you want some tax tips on how to save money by building your own bank, check out Tax Strategies GPT. And if you want to reach out to me and Big Al, you can reach out to either Big Al at tailoredtax.ai or Terrence at tailoredtax.ai. So BIGAL at TAYLOREDTAX.ai or TERRENCE at tailoredtax.ai. All right, folks. Thank you. See you soon.
Cheers.